a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about small cap ETFs. And investors have piled into these small cap stocks and ETFs since the June inflation report raised the odds of interest rates cuts by the Fed. And it was a violent rotation initially. Investors sold the Magnificent Seven stocks and they bought cheaper areas of the market. And it was reported that this rally was violent and it was accelerated by short covering by some hedge funds because small caps had been underperforming for a long time. So many hedge funds were short these small cap stocks and ETFs. Now, it remains to be seen whether this is an inflection point for small caps or just a technical move. And after underperformance for the past so many years, small cap stocks do look quite cheap. They are attractively valued. And in fact, the difference in valuation between the two groups, the small caps and large caps, it is the widest in 20 years, according to some measures. And earlier, these stocks were hurt by recession worries, higher interest rates, because they are particularly sensitive to the economy. These generally have a higher debt burden and mostly at floating rates. And additionally, about 30% of the Russell 2000 companies are unprofitable. So that is why for the rally to continue, we will need to see earnings growth. And so investors will be focusing on earnings, and earnings continue to roll on. And for mega cap companies also, so investors will be focused on earnings growth, and they will see whether the earnings growth justifies the huge capital in spending on artificial intelligence. And if it doesn't, then investors will probably sell mega cap stocks again. In general, mega cap companies have huge cash piles, and many of them had refinanced their bonds to take advantage of low interest rates earlier before the Fed starts raising rates. And also, so that is why they were doing well in the higher interest rate environment. Small cap stocks, which are domestically oriented, they are more sensitive to economic slowdown, and they will be more sensitive to economic growth also, that rebounds. And being domestically oriented, these could potentially benefit from a Trump presidency, the odds of which went up after the assassination attempt on the former president. Now, there are two small cap indexes which are quite popular. In fact, Russell 2000 is more popular than the S&P Small Cap 600 index. But looking at the long-term performance, there is significant difference between the performance of these two indexes. And I looked at the performance between the performance of the two most popular small cap indexes, the IJR ETF, which tracks the S&P Small Cap 600 index, and IWM, which tracks the popular Russell 2000 index. And since May 2000, IJR is up 886%, have the performance here. And whereas the IWM ETF is up only 573%, so significant difference between the performance. And according to S&P Dow Jones, they conducted a detailed study, and their study showed that the difference is mainly due to the profitability factor in the S&P Small Cap 600 index. So to be included in the S&P Small Cap 600 index, the companies, small cap companies, they must meet certain market capitalization, liquidity, public float, and profitability measures. Whereas in case of Russell 2000, these are just the smallest 2,000 companies in the Russell 3000 index. So the first 100 go in the large cap index, Russell 1000, and the remaining 2,000 go to this Russell 2000 index. And while the long-term performance is in favor of IJR, this year IWM has done better. Russell 2000 has done better. And that is mainly because as Supermicro and MicroStrategy, they were included in the Russell 2000 index. They went out of the Russell 2000 just after the annual rebalancing in June. And although these two stocks, they had become too big and they were no longer small cap, but because of the annual rebalancing, they stayed in this index for a long time. And most of the gains of the Russell 2000 index this year were driven by just two stocks. Now let's take a look at these popular ETFs, and I will highlight two more ETFs that I like. So this is the iShares Score S&P Small Cap ETF, very popular. This is the largest small cap ETF now, IJR. And as the name suggests, tracks about 600 stocks in this index, 86 billion in assets, ultra cheap too, just 6 basis points expense ratio. And so if you want to learn more about this ETF, you can go to the quote page on Zacks.com, and using the link, you can go to IJR's webpage for this ETF. So this ETF is up about 10% year to date. And if you look at the holdings, you see all these ATI, Ensign, Fabrinet, Miller Industries, not very well-known companies. Small cap stocks do not get a lot of news headlines or analyst coverage also. So that is why it makes sense to invest in ETFs if you want to get exposure to small cap stocks. The second ETF that I'm highlighting again, which we talked about, the IWM, this is also very popular, but this is more expensive. This charges 19 basis points and has 73 billion in assets. And again, as the name suggests, 2,000 stocks, no profitability or any other criteria to be included in the index. But if you want to take a look at this ETF, you can go to the quote page again. You can read our research report articles, and using the link, you can go to the iShares webpage for this ETF. And I had mentioned earlier that this has done better than IJR. So this is up about 12% this year, slightly better. And again, mainly because of those two stocks which have already left the index now. And these are the current holdings for this particular ETF. Now, the third ETF which I'm highlighting, and I actually own it in the ETF investor portfolio that I manage. This is the best performing small cap ETF over the past year. And that is because this tracks 120 stocks from the S&P Small Cap 600 Index, which have the best momentum scores. So best price momentum, best performers are included in this index, slightly pricey because of this specialized methodology. The ticker symbol is XSMO by Invesco and has 1.1 billion in assets. So again, let's take a look at the CTF. So 120 stocks having the highest momentum scores. If you look at holdings, Insight Enterprises, Miller Industries, Stolt Building Products, Meritage Home, these are the top holdings in this ETF. And the next ETF that I'm highlighting, this is an actively managed ETF and has done quite well since its inception. And take a look at this ETF if you want to consider small cap stocks with very low valuations, the cheapest within the small cap universe. So this actively managed ETF AVUV by Avantis. This looks at stocks with low valuation and high profitability ratio. So you get low valuation plus some quality factor there. Slightly pricier than IJR, obviously, which is the ultra cheap ETF. But it has become quite popular with investors at 13 billion in assets and charges 25 basis points. So again, let's quickly take a look at the ETF, what it holds. If you want to take a look at the holdings, you will see these companies: Jackson Financial, MDU Resources, Boise Cascade. These are the top holdings. So you will see some common stocks within these ETFs. On the next slide, I have the comparative performance of these 4 ETFs versus the S&P 500 index over the past 1 year. And the Invesco product, which focuses on highest momentum stocks, XSMO, that is up about 35% over the past year. And the Avantis product and the S&P 500 index, they are both up about 22%. IWM and IJR, they are up about 16-17% over the past year. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. And also make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.